Hi. I'm Audra Gaiziunas. I am the owner of Brewed for her ledger, and I am an owner in Dissolver in Asheville, North Carolina. This is my 6th New York CVC, and very excited to be back. I was your keynote last year, and to commemorate that occasion, I got a tattoo yesterday. I got 2 barley stalks done, so I have New York ink now in my leg, next door to my Colorado ink from the 2019 CVC. But I'm a fractional CFO for the industry. I started out at Dogfish Head back in 2009 and served as their controller, went on to become the CFO of Mother Earth Brewing. I've owned my own consultancy since 2013 officially, 2010 unofficially. I've worked with about 350 breweries from coast to coast. I am the fractional CFO of Burlington Beer Company up in Vermont. I'm working with Von Trapp Brewing right now with a lot of data automation on their back end from the lodge and the brewery perspective. And then I slot in wherever people need help. So most of my brewery partners are less like 2,000 barrels or less, a few in the 3,500 range, but I work with the smallest of our producers because we can't afford to have a full-time CFO on staff. Maybe you just need 5 hours every 6 months, or 2 or 3 hours a quarter, and it just makes financial sense for a brewery that needs that level of help. And I get to travel to the most interesting parts of our country that way too, and just meet up with a lot of folks. I'm also a home brewer. I've been homebrewing ever since I started working for Sam Calagione because his stories were freaking amazing. And I was like, he did that, I want to do that too. So I went all grain from the very beginning. So my first batch was in 2009, and to this day, Saisons are my favorite style to brew. I have a half barrel single tier rim system. In the back of my house, we have a German Shepherd named Simcoe and 2 black cats named Porter and Stout. Beer is everything to me. It is it's my home. And so it's very exciting to be back here in New York and Albany. This is the only time I've ever come to Albany. But I got to experience Fire and Ice about 10 days ago too, at Prison City. And that was such a wonderful, wonderful festival and such a great showing from a lot of different breweries that came over from all over the state. So it's nice to be back here. So we're going to talk about how we're going to utilize cost of goods sold as our skeleton key for strategy, and how I'm going to show you my process and how we take our traditional income statement and flip it in such a way that we're going from backwards thinking to forwards thinking, and then I'll show you all the different ways that I've set up some of my workflows so that I can say if I want to make a certain amount of money in the upcoming 12 months, let's say I need to hit $150,000 of net income, what is it that I'm going to have to sell, and how am I going to have to sell it? What does my sales mix have to look like? So it's a lot of data and a lot of nerdy stuff. And the other thing is, when I presented last year, I went through a lot of information in a very short period of time. People liked the presentation, but I didn't dig deep into certain places because we only have an hour. So I'm coming back to some of those processes, and I'm showing you an example that's step by step so that you can follow it along. Apart from the conference, especially after a beer or 3 or whatever we've had since this morning. And you can bring it back and say, okay, I can teach this to my staff. I can handle this on my own. It's just a different way of looking at things. So traditionally, the profit and loss statement, we accountants follow generally accepted accounting principles, GAAP. And there's financial accounting, and then there's managerial accounting. There's 2 main facets when it comes to accounting. In financial accounting, the reporting that comes out of the financial accounting side has to follow a certain set of rules. And what we traditionally see is something that looks like this, correct? So the inputs come by either we're putting in our AP, AR, or we're handing it off to our bookkeeper or accountant. They are inputting a bunch of information, both revenue and expenses. We have some processes that are automated. And then the end of the month comes and we do post our inventory adjustments. We look at our financials and it's like, how did we do for the month, right? So we're used to a lot of like backwards type looking data. The month has passed, we're reviewing it, and now the same processes go forward for the upcoming month. So the P&L, it does show the performance of the brewery over a period of time, and we're used to saying, okay, it includes revenue, big section on revenue, cost of goods sold, and then operating expenses. They all follow the same format, regardless of which business model you're at. And hopefully your chart of accounts has your sales line items lining up with your cost of goods line items. So that's one of the first common mistakes that I find. A brewery is going to have, they may segregate their different arms of the business and revenue, but then cost of goods is all one bucket. Well, how well do you know, how profitable are you based on those various lines of business if you're not separating it out in your financial statements? So here I have like taproom revenue and taproom COGS, wholesale revenue and wholesale COGS. And for this example, we're just going to say it's going to be all direct materials. And we'll go through that a little bit more closely here in a couple of slides. But want to make sure that you're separating out and delineating your arms of the business by revenue stream and then matching up with the cost of goods sold stream so that you can see how profitable is my taproom, how profitable is my wholesale arm. If you have a restaurant, that should have its own category. If you have a bar, spirits and RTDs, non-alcoholic, other options, they also have their own key performance indicators that are apart from everybody else, so that you could have 4 or 5 different lines of business. Just make sure that your cost of goods are aligning with those 4 or 5 revenue arms. Some common income statement key performance indicators we commonly look at the end of the month: gross profit margin, net operating income percent, and then net income as a number by itself. So again, we're inputting all this information. The end of the month comes, we post our adjustments, we're looking at how well we did, and then we move on and do the same thing over again. Very backwards looking, very process driven, and doesn't take away from any of that, but it doesn't allow us, people that are operating in the brewery from day to day, to make any sort of proactive decisions. We're looking at things backwards and then kind of like, well, I guess we should change this, or I wish we could change that. But what if you flipped your income statement and reimagined it and took these line items and reassembled them in such a way that you could say, okay, based on this information, here's what I should do over the upcoming 3, 6, 9, and 12 months. So that's what we're going to walk through. But before we do that, kind of give you a little bit of background on the managerial cost accounting side, which is what we're going to go through today, is that this arm of accounting is specifically for managers who plan and control breweries day to day. If you're in the operations, if you're in the weeds day to day, especially if you don't have any finance background or accounting background, this is where you should be. You should exist in this space. Pretty much everything on the cost accounting side has a future perspective. So financial accounting, backwards, we're reporting to governmental entities. We're reporting to our investors, to our banks. But the managerial side, managerial accounting, is very internally driven. You can come up with your own models every which way you want, and it doesn't have to follow generally accepted accounting principles. So you can come up with your own economic models, and having just a basic understanding of financial reporting, you're like, oh, I can take that data and I can reassemble it in such a way that now I can make these forward-thinking decisions. It also emphasizes the relevance for planning and timeliness and focuses on segments of the brewery. Financial reporting, like we looked at the P&L, you're looking at the overall brewery operation and the overall performance. But you can build models within production. You can build models within admin and sales and marketing and have them fully functional, operational, coinciding with the financial reporting piece. So every single product that we produce has 3 cost components, and it's going to be direct materials, direct labor, and overhead. That's it. Direct materials and direct labor can be directly traced back to each product, each batch that we produce. So that's going to be your bill of materials for direct materials. It's your recipe. It's what you input into ECOS or Beer 30, your 7-barrel batch, your 10-barrel batch. You know exactly line by line how much malt, hops, adjuncts you're using. You can trace it back. Direct labor, same thing. You know how much time it's going to take for you to produce this beer, to brew it, to cellar it, to package it. It's directly traceable back to that batch. If you can't trace it back to the batch, it's overhead. That's it. That's how simple that is. If you can't trace it back to the batch, it should be an overhead. An overhead is just, I know it's like this nebulous term that sits in the ether. It just refers to all the ongoing brewing expenses that are not including or related to direct labor and direct materials. So, and anything that would be a pass-through. So if you're collecting sales tax from the customer, putting it in a liability account, and dumping it out the next month to the New York Sales Department of Revenue for your sales tax, for example, it's neither a revenue nor expense. You're holding on to it as a pass-through entity. So none of that is included in here. And you have to pay overhead on an ongoing basis regardless of whether you're doing a lot of business or not brewing beer at all. So we use overhead, and we should be looking at overhead from the perspective of not just budgeting, but to determine how much the brewery must charge. We use it as part of our pricing strategy. So when you understand overhead, it should slice in and slot into your overall pricing strategy and what you need to accomplish as a brewery, what you need your minimum service that you have to provide, and what profit you have to make in order for your financial goals to be met for the year. So one step to look at, a best practice to come back to your respective breweries, is understand what your fixed overhead is. If you produce 0 barrels for the month, sold nothing, so no production sales activity, what expenses will you still have to pay? So have an understanding of what that is. What is that floor? Because that's going to help determine your minimum that you have to eventually to sell when you start looking at break-even scenarios and a break-even analysis. So if you produce 0 barrels for the month, sold 0 barrels, which expenses would you still be responsible for? Know what that number is. Overhead is also, because it's kind of nebulous and not easy to grasp, like it is recipes or labor, we just tend to ignore that piece when making these pricing decisions. So we need to bring that back in to the mix. We know, oftentimes I see pricing decisions being made on, okay, here's the recipe cost, here's the labor cost, this is what we should charge, and this is how much profit we'd make. But is that enough to cover all of our rent and utilities over the long term? So we miss that piece when we make a lot of pricing decisions. So we're not seeing at least a third of that data when a lot of pricing decisions are made. Know that overhead can be fixed or variable. So fixed overhead expenses are going to be the same from month to month, and variable are going to increase or decrease depending on the brewery's activity level. They can also be semi-variable. So semi-variable overhead, you have a portion of the expense that is fixed and a portion that is going to be variable. So thinking about your own personal cell phone plans, we have a fixed a line fee or utilities. You have a particular line fee that you're going to have to pay regardless of the level of activity that you have. And then you have data plans that you have that you pay for on top of that. So my kind of general rule with that is, which expense is the more material of the two? Is it the fixed component or the variable? And for now, dump it all in that side. If it's largely fixed, if it's 80% fixed and 20% variable, put it in there. Put it into the fixed category. You can always pull it apart later, but for simplicity's sake and consistency, just put it in that category. Overhead can also be general, and for the purposes of today's talk, we're going to keep it all general. But that overhead can also be production overhead. We can have production overhead. We can have sales and marketing overhead. We can have admin overhead. It can be departmental. You can add more complicated layers to this so that you can start setting key performance indicators based on the function that you have within the brewery. But for today, we're just going to have it all in one category. So there are 4 types of costs that each brewery encounters. Every single brewery encounters this. They may not be the same in the amount, but every single brewery has direct costs or indirect costs and fixed costs or variable costs. In other words, every single line item on your income statement from the cost perspective can be labeled with 2 of these 4 tags. They will each be direct or indirect and fixed or variable. So direct costs can be directly traced back to the product. We just talked about material. That is going to be your recipe. Your labor costs, time it took for you to brew, sell, or package, it can be directly traced back. But then we have indirect costs as well, that it's part of the production process, but the costs are allocated based on some level of activity. So that could be like the shrink wrap you use for putting together, assembling and pushing together all your kegs before you put it on the distro truck. It could be water conditioning materials that you're using. It's not directly traceable to each batch, but it is part of the production process. So that would be an example of indirect. And then fixed costs, they're not going to not going to vary with the level of production, like a lease on a building, insurance, your dues and subscriptions that you have. Whereas variable costs will change with the level of production. So those same materials, that same recipe that we're using, it's going to go up. If we produce more, it's going to go down if we produce less. So just getting a good handle and a good starting point would be coming back through your traditional profit and loss statement and go through each line by line and label each as fixed or variable and direct or indirect. So in this example where I showed the income statement before, here we have the same income statement for the year for this particular brewery. And the assumption here is that cost of goods are all direct for this example. There can be indirect COGS, as I talked about. There can be items that you're adding that is not directly traceable back to the batch, but is part of the production process. But to keep it simple, all COGS are direct here. So I'm going through taproom COGS, wholesale COGS, taproom COGS, variable direct, wholesale COGS, variable direct. So on and so forth. I'm going to go through every single line item on my cost or on my income statement, and I'm going to label with these 4 different categories: fixed, variable, and direct or indirect. So that's step 1. So I looked at that. Cool. All right. Gives you a good sense of where your economic model lies, because your variable expenses you have a lot more control over. Your fixed expenses you have less control over. So the greater amount of fixed expenses that you have, the greater amount of legwork you're going to have to do to get to break even, for the most part. So we label everything in here. Okay. So then we calculate our overhead. We determine overhead. It is not going to be anything that is direct materials or direct labor. So back here, it's basically everything that is below total COGS. Those line items from interest all the way through other. It's all indirect. So that's overhead. So those line items move over here. And for our example, for this brewery that for year 2 of its operations, it produced 2,000 barrels. Converted to gallons, that's 62,000 gallons. So I take that 1,054,320 of total overhead that I have here, divide that by, you can do it by barrels or by gallons. We are going to do it in barrels in a little bit, but by gallons, it's $17.01 per gallon. What does that mean? That means when we are looking at beer that we're producing, every single batch of beer that we produce, we know that our 7-barrel batch is going to be X amount of direct materials per 7-barrel batch. Therefore, we can divide it by 7 and get it to a barrel level, and then another 30 by 31 to get it to the gallon perspective. We know what our direct labor is. Now we should include that overhead per gallon rate as our total all-in recipe cost. And then look, if If we charge X, and this is what our revenue is that we're realizing per barrel or per gallon, how much money are we truly making? You may be surprised that you're losing money when you add the overhead piece in there. So then you have to take action on that. But good place to start is like, how much is it all in for us to operate based on our current level of activity? And in this case, it's 2,000 barrels. Okay, producing 2,000 barrels, 1701 per gallon, multiply it by 31. Now I know per barrel how much it's costing me to run my business. Sidestep for a second and talk a little bit about the break-even point, because all of this is going to be integrated together. The break-even point is that level of sales where your profit is going to be zero. So that formula is sales minus variable costs minus fixed costs equals zero. So in order to determine sales, you're multiplying your sales per unit by unit sold. To determine your variable costs, you multiply the variable cost per unit by the same number of units sold. And that formula equals zero, that's your break-even point. So, a little algebraic formula, sales of X, where X is going to be barrels, in our example coming up, but it can be cases, it can be pints. You can take this formula and apply it to whatever arm of the business you so choose. Sales of X minus variable cost of X, that's on a per unit basis, less fixed costs as an overall pool. Where it's zero, that's your break even. So in this scenario, simple scenario, we have a sales price per case of 36. Our rent utilities per month is what we pay here. And then barley, hops, our packaging, excise tax, and labor are on a per case basis. We slot all that in, 36X minus 750, which is the sum of the barley, hops, packaging, excise tax, and labor per case of X minus 1250, which are those fixed cost pools of rent and utilities. Shuffle some things around, some 8th grade algebra over here, and we get 2850x equals 1250. We solve for X. For us to break even in this operation, we have to sell 44 cases. That's a simple version of it. So let's come back to our profit and loss statement here. Take it through a similar exercise so that we can pull out and tease out that S, the sales, the variable cost, and the fixed cost pool. So remember that you've gone through your income statement now, line by line, and you labeled each as fixed or variable and direct or indirect. Each one has 2 labels. You can draw yourself a big quadrant. You can do it in Excel, however you choose, but add up now the totals of each of those 4 buckets. You have your fixed bucket, your variable bucket, your direct bucket, and indirect bucket. Your check and balance that you did that correctly is that your total should be exactly 2 times your total expenses, right? Because every single line item has 2 labels. So divide that by 2, and that's going to tell you that you did things correctly. So we're coming back to this profit and loss statement. I've labeled everything with those 4 labels. And I come up with the F bucket total of $1,015,000, our variable bucket at $519,000, direct $481,200, indirect a little over $1,000,000, $105,420. The total is $307,140. Divide that by 2 to $1,535,520. Sure enough, that is equal to that $481,200 plus the $105,400. So the $481,200 in total COGS plus the total expenses. That is $1,535,520. I did this exercise correctly. So I got my 4 buckets. One thing you can do immediately is you can divide your indirect bucket by the number of barrels you sold last year. So 2,000, in this example when we're looking at overhead. And that is going to give you your overhead rate per barrel. So that $1,054,320 I bucket divided by 2,000. We've calculated now $527.16 of overhead per barrel. Now you're slotting that in when you're creating your pricing scenarios. That's more forwards thinking. If I know that based on 2,000 barrels of activity, it's costing me $526 or $527 just to keep my lights on, that should be part of our pricing scenario. Well, how would that change if we go from 2,000 to 2,500 barrels? How would it as it increases to 3,000 barrels. Our overhead rate should go down over time. We should, as we're getting more efficient and our sales continue to grow. If it's not, we need to look at how we're operating internally, because it should be going down over time. But take that 527.16, and now you can look at it from budgeting, looking more forwards. We should make X more if we're going to be selling more beer in the upcoming year. So that's using the I portion of the quadrant that we just calculated. But now we want to bring it back to the break-even scenario, the break-even formula. So you take that variable bucket, divide that by the number of barrels you sold over the past year, 2,000, and that's going to be that VC component of our break-even formula. So we see 519,840 divided by 2,000 barrels, 259.77 of variable costs. That's going to be the VC component of our break-even. Keep your fixed bucket dollar as a total. That's it. That's going to be your FC component for the break-even formula. So here we just leave it alone. It's 1,015,680. Leave it. Then you divide your total beer sales dollars by the number of barrels that we sold over the past year, and that's going to be the S component of your break-even formula. So here we can see it's 1,632, 1.6 million on total revenue. Divide that by the 2,000 barrels. Our revenue per barrel, 816. So now you have all those components that you need for your break-even formula. You've taken your profit and loss statement and you've flipped it in such a way that now it's going to tell you what it's going to take for you to break even without you having to look at the overall results and not be backwards looking. If you have been showing losses over that last year, over the last months, what is it that you want to set as your financial goal? Is it break even? Awesome. Set that to 0. Maybe you have another goal, like we have to make $150,000 this year because our investors require it. We need it for debt covenants, whatever it may be. Instead of 0, you put in 150 in that number. So taking that break-even formula, based on how we're currently operating and have our actual results, the algebraic formula there, we replace it with the 816 per barrel of sales of X, and then subtract out the variable cost of 259.77 per unit X, minus the fixed cost pool at 0, so break even. Again, some algebra, move things around. And us to break even, we'd have to sell 1,826 barrels for this particular model. Does it make sense? We sold 2,000 barrels last year, right? So if our break even is 1,826, we better have a positive net income for that additional 180 barrels that we sold. And we do. We see it. It's 96 and some change over here. So we know what our break even is, and we know where we currently sit. You can use this formula to project forward. So instead of 0, put in what your goal is over the upcoming year, and that's going to tell you how much you're going to have to sell in order to get there. This is as an overall entity. Can you do it you can break it down by each arm of the business. You can break overhead apart by function, but this is for the overall model itself. So a different way of looking at things. It's a different way of taking your profit and loss statement and saying, I need to make X in the upcoming 12 months by the end of month 12. What's the direction I'm going to have to take in order to get there? So it flips it. You go from backwards to forwards thinking. Other key performance indicators to track will include your production labor dollars per barrel sold as well. Make sure to include your payroll taxes and benefits in that calculation. Your total labor dollars per barrel sold, which will also include payroll taxes and benefits. Know what your trailing 12-month net income is or loss is. And then knowing that 12-month net income or loss number, you can calculate what your incremental weekly sales need to be in order to break even or reach a goal. Break apart taproom sales from wholesale sales. and use the gross margin for each division of the business because they are going to be wildly different and they should have different key performance indicators attached to each. I presented this model briefly last year. We talked about it, a little bit about how it worked. I wanted to go through a few different line items and tell you where this information should be coming from within your financial records. So if we go to your excise tax, if you're going through your target cost or target price that you want to charge the consumer, this all calculates backwards with all the different formulas I put in, but if we go down to freight per case from A to B, you know how much you've sold in cases, and your total freight dollars should be its own line item in your income statement. So you should be able to calculate it using your income statement and whatever you're using for inventory management on a case basis to get that cost, to pull that cost. You have your excise tax already in there. You can pull that off of your excise tax reports to get to your target FOB per case price to the wholesaler that you should be charging. And then what is your minimum gross profit margin that you have to make? Well, if you're following this whole break-even scenario and analysis, you know how much you need to make in order to cover all of your operating costs, right? Because you know what your fixed overhead is going to be. So you should be able to walk backwards into what your minimum gross margin percentage should be to reach a particular goal. Then you have your excise tax per case, you have labor and overhead per case. These are going to come off of your payroll reports, and then your overhead, you've already just done this exercise. You've pulled apart your costs and resegregated them in such a way that it's direct materials, direct labor, and overhead. And divide that by the 2,000, whatever number of barrels is that you sold. So you have all of the components already on hand in order to help you decide what direction you need to take in terms of pricing and what your target ingredient cost per barrel should be based on your pricing strategy. So this model is included also in the presentation, but I use this a lot because what I want to do is I want to determine if there's a beer that I have on tap and I'm trying to decide whether or not it makes financial sense for me to can it, if I've never canned it before. Taking it through this exercise will help me determine whether or not it makes financial sense. Because I'm going to have a target price that I'm going to charge to the consumer. I'm going to have a minimum gross profit margin I have to make. And I could, mess with the yield a little bit, of course, and get a little bit more out of my production. But if it's an IPA, if you're making 85% yield, awesome. But you have target ingredient cost per brewed barrel then, and that gives you your kind of directive from the production side and how you're going to be crafting recipes going forward in order for you to meet that gross profit margin and be able to charge that price point. If that number is way too low, if let's say your IPA that you have created and you are selling through the taps is $130 for you to brew, you're either going to have to reduce your gross profit margin, where it's currently 35%, to 30, 25, and as you reduce that number, the target ingredient cost per brewed barrel will go up. So you can see how much you're making now based on how your current recipe lies. And decide, maybe I should change the timing of the hops a little bit, maybe I change the supplier for some of the malts that I'm using without sacrificing quality, of course, but it might be a good time to reanalyze all your recipes then too, when you take it through this particular exercise. Or if you're not willing to take the gross margin down, raise the price of the 4-pack 16-ounce cans. It goes from $15.99 to $16.49, $16.99, $17.99. So as that sell goes up, your target ingredient cost per brewed barrel will also go up. And then you decide, will the market be able to accept it? It might be a combination. You can raise the price a little bit and take a little less margin, or again, reanalyze the recipes that you have. There's 3 main levers that you can push here when you're looking at whether or not you want to, or does it make sense for you to can this beer. And it's a really good conversation to have amongst all of the folks at the brewery. Yeah.
Beat up your packaging suppliers too for lower costs.
Oh my gosh,
Saved
yes.
a lot of money when we started doing that.
Good. Yes, that's another great place. That's why also I keep those inputs blue. So all of my cells, when I work and build financial models, input cells are blue. All the formulas happen behind the scenes in the black cells. I just leave that alone. But because you can look at it from that perspective, if I went with this supplier, this is how much it would save me, or I have, I would make X much more, amount more, based on a certain level of activity that I have. But it also helps with, if you've been mobile canning, especially smaller breweries that don't have their own canning line, you can look at it from the perspective of, okay, well, I'm at the mercy of this mobile canner, and I'm taking whatever inputs they are charging me, and that's what I have to work with. More than likely, you're paying a surplus for that fact. If you were canning in-house, a lot of those components are actually going to be less for you to be able to source on your own. So you could then take a look at what that looks like from the component perspective, reduce that number to where it would be if you own your own canning line, and you can start to build a financial case for payback period and how much savings you would have by bringing canning in-house versus having it out at the mobile canner or having them provide that service. So this I use for lots of different financial scenarios, but from the overall perspective, I have this beer, it's doing really well, I've never canned it before. Is it a good decision for us to can? Let's take a look at it from what it would do for us if we decide to can it. Make some decisions around that, and then proceed forward. Or not. Just say, nope, not worth it. Can't do anything else with the recipe. Can't, the only thing I can do is take less margin, and you may have to crank it down to like 5% or 3%. Is it worth it? Maybe. Maybe not. But at least you know then how much you're making as you're deciding to go forward or not with that decision. So again, much more of a forward-looking perspective. And it incorporates overhead, which we haven't done before. A lot of times we look at just the labor and the bill of materials and be like, yep, we're going to make some money based on that. But here, you are forced to include overhead in here as well. So it gives you a lot more clarity as to whether or not it makes financial sense. Yes, question?
So the 35% that you're putting there, is that just an example for this
Yes.
slide?
It's a very example. I cannot talk about specific price, and I cannot give you exact ideal margins.
Exactly.
So, yep. That whole price fixing thing, and yeah, I can't. But that's the beauty of the model too. Like you could put in 40, you can put in 30. Everybody's overhead level is going to be different. Some people are operating in very high cost areas. Like if you're in the city, my goodness, like your overhead because it's your rent, is insane. Versus, I don't know, Cooperstown, for example. Like the rent's going to be less, than the city. So the overhead in general is going to be a lot less. Plus, you may have some resources on hand. You may own some real estate. There's just so many factors that come into play that I can't give you an ideal profit margin anyway. This can be set up from brewery to brewery. They can look widely different and still give you the same type of visibility and clarity that you need to move forward based on, you can do it by location. You can have way different answers based on location too that come up based on what you're paying and where you are located. But it shifts it again to more forward. Not like, well, there's hope. I remember I had a business school professor back in 2006. He was an entrepreneurship professor that said hope is not a strategy. And sure enough, it still rings true to this day. I'm sure Julie said it this morning too. Hope is not a strategy. Having a financial model like this, it tells me whether or not I should proceed forward. Then I do it at least with some idea and sense of knowledge. And it's not just hope. And it's not it feels like a good thing to do. Does it make financial sense? I mean, with everything that's being thrown at us right now and how mature our maturing industry is changing and how consumers are so fickle. Like, we really need to make sure that we're looking at every single one of these types of decisions from that forward-thinking perspective and make sure it does make financial sense. So a lot of us can't afford to do mistakes like this anymore, where we used to be able to. Got enough cash in the bank? Cool, I'm just going to try this and see if it works. We can't do that anymore. So that's why I'm making, like, I've made such a big push for the BA to put out additional financial resources and information and financial education as it relates to our industry for a decade now. And we're finally getting there. And it's just like, we need this information, because at some point, the stuff's going to slow down and people are going to be like completely taken aback. And I wanted to make sure that we are armed with those types of resources. So if you haven't been forward thinking yet, this is the time to do it. And we'll get there. And it's not that overly burdensome, and you can pull some of this information from either this presentation. I can send it to you. It's just start using it and start looking at it in a different way. So again, like that P&L, if we look at it from the perspective of direct materials, direct labor, and overhead, and start managing our overhead per barrel, we can move mountains a lot more quickly than we can just by looking at our income statement and balance sheet. It's a way different way than the traditional viewpoint that we've had in the past. So, if we know what our direct materials are per barrel, and we know what our direct labor is per barrel, and we know our overhead per barrel, now we know our all-in cost that we can figure out to the unit level. It's a lot of information, but this is a grid that I created that I use for projections. So if we know all in how much our unit costs are, this is in the red column. I'm sorry if it's difficult to see. I wish I could make it even bigger, but again, presentation will be available to you afterwards. But if I know what that is, I can use just direct materials in those red cells. I can use direct materials and labor and overhead all in total, and then take that per barrel, per gallon, and convert it into sixtels, convert it into cases. I have all this information right now already in front of me. I'll convert it to the unit level and put it in those red cells. And then I'll put a wholesale price. I have a wholesale price column and a retail price column too. So I can start playing with those levers and look at profitability from that perspective. Now this is the fun part. So we know, like, let's say the 2,000 barrels that we had for this brewery just did 369 barrels of sales. You can see in the year one tab up here. That line, that total barrel line, that's going to give us our sense of seasonality that we have when we go month to month. We can use that for projections going forward as well. But to get to that 369 level, that's at 2,000 barrels that I was going through before and taking you through all those examples. For this particular brewery, it's 369. So we know how many barrels and we know how many per month. Now we take all of our different brands, our different styles that we have. We know what the unit cost is going to be in the red cells, and we can start playing with the sales mix column. So if we're selling this much beer, what if we sold 10% more IPA? 10% more Pilsner and less of others. This should flow out into your profit and loss statement from the revenue and profitability perspective, and you can immediately and dynamically see what impact that would make on your financial results. So the way I have this set up is it begins with the barrelage, and then the first thing you do is when you have the sales that you have on the top, the next, you have that across the top, and that's based on seasonality. The next thing that you do is you take your allocation based on packaging type, and perhaps the starting point will be, how are you selling product now? How is your beer selling now? How much are you selling in cases and cans over the bar? How much are you selling in pints? How much are you selling in sixtels? You get that from your point of sale, you can get it from your sales reports. Slice and dice that data, put that in there. That's your starting point. And then what that does is it takes that percentage of package type, applies it to that sales number up above, and then you get those tan rows that shows total in barrels, and it allocates that much product to each going forward. So let's say if it's not 369, that may be our starting point for year 1. Year 2 could be 2,000. We would apply that same percentage based on how beer is currently selling and scale it up to the different product types. So then we have how many we have in barrels. From that point, I have everything converted down into units here. And you start playing with that sales mix column. So if I currently have 12% IPA, what if we were 22%? How much more profit am I making off of that? Hazy, like all your different styles. If your cost of goods are vastly different based on your bill of materials, this is a time for you to see how much more would I make if my goal was to sell 2,000 barrels for the upcoming year and I sold 10% more lagers, 15% more seltzers. You can immediately see that financial impact by using a grid like this. You've already calculated overhead, direct materials, labor. You have everything here. Now you start to play with what if going forward. When I build projections for startup breweries and we go through expansions, this is the meat and potatoes of pretty much every model that I work with. It looks like this. And it's fun because you get to give it to your team and you get to play with these numbers and be like, oh, you're now playing in a world of possibility. It's not like just how much money are we gonna make? Like, oh, what if we made this like super innovative beer that nobody else is making in our region, and it costs this? How much financial impact are we gonna have on our brewery? We're gonna make this much more. Now we can invest in our taproom experience. Like you start to play in a what if realm rather than we need to make X. It's more of the perspective shifts to what if. What if? So that, I love this. It took me 7 iterations to get it to where I really liked it. And you can add quarters, you can add halves, you can make this as complex as you would like. But the logic is the same. And it just gives you that freedom to play in that what if space. Forward thinking, projecting forward, looking forward. That flows out to your profit and loss statement. You're going to have your revenue and your COGS. Done. Now, what impact does it have on our cash flow? So I use the indirect method when I create a cash flow. Direct method means it's all of your direct cash, like the cash that's coming in minus the cash going out. That's direct. Like if you're collecting all these receipts this month, here's the cash in, here's all the expenses I'm paying, here's the cash out. That's the direct method. The indirect method assumes a certain level of activity. Perhaps you align it with your fixed overhead. You know that you're going to have a certain level of activity, and the indirect method looks at the deltas from that standard, from that set level of activity. So you get to play with seasonality more here. You know you're going to spend, this is your average. Some months you're going to spend more, some months you want to spend less, but by looking at the deltas, you get to see the influx and outflow a lot more clearly. If you start projecting based on a certain overhead level, you start with net income, you add back non-cash, depreciation and amortization, and you have your net cash from operating activities that mostly is going to be concerned with, I have nothing in here right now, but additions and depletions in inventory. When you play with seasonality, that's going to dip down or come up. So when you see negatives, that means you're purchasing more inventory now, you're purchasing more materials because you anticipate selling more beer in the upcoming 4 to 6 weeks. You're getting into high season. So you're going to see a negative cash flow impact because you're spending more than usual on your inventory. you should see a positive effect from the inventory perspective in winter when you're kind of relaxing on how much you're purchasing. Maybe you're going to be a little bit more efficient with the brew house too. Like there could be other things that happen, but you're purchasing less inventory. So you'll see a positive cash flow effect because it's less than the average. So you're looking at the changes from your standard instead of directly in, directly out. And that to me is more intuitive because it gives you a better sense of your seasonality and gives you a better sense of how you should plan going forward. But then you have your long-term, your loan payments that come through here as well. It's going to be part of your financing activities. But by looking at the cash flow and taking that net income that you're making now projected forward, using something that looks like a model like this, you can now project your cash flow going 12 months forward easily. And this is what you have your beginning cash balance of 54,576. You look 12 months from now, your ending cash is going to be 40,823. Ooh, we're losing cash. So we may be showing a profit, but we may be losing cash because we're not making enough profit. Our net income isn't high enough to meet all of our debt obligations and the timing of our payments that we're making. So now you can change activity too. You can come back to this grid and be like, we need to sell more product that costs less to produce, or we need to rethink a recipe, or push, more tap room, whatever it may be, so that you can at least become cash flow neutral. Because here, we're losing $14,000 for the year. Again, you're looking forward before this is happening, so that you can adjust your recipes as you need going forward. You don't know where to start? I talked about this last year, and I will reemphasize it again. Not sure what your target net income should be. Look at your debt service that you have. So on your balance sheet, you have long-term debt, and then you have short-term debt. Your short-term debt is going to be your credit card payments, your accounts payable, everything that you anticipate in paying over the upcoming year. But then you have a long-term debt also. So you have these debt payments that you have to make. Create a debt schedule for upcoming 12 months from each loan that's sitting on your balance sheet, and then take the 12 months total of all of your debt service payments. That includes principal and interest. And then multiply that result. So you've summed up all of your debt that you're going to pay over the upcoming 12 months. Multiply that number by 1.2. That should be your target EBITDA, or net operating income. This target 1.2 comes from banks. This is called the debt service coverage ratio. It is calculated as your numerator being EBITDA, earnings before interest, taxes, depreciation, amortization. Otherwise, in this example, known as net operating income. I use that interchangeably when I'm doing this calculation. But net operating income is your numerator. It's for the upcoming 12 months. The denominator is the total debt service that you are going to owe, both principal and interest, for the same upcoming 12 months. That result needs to be 1.2 or higher. That comes directly from banks. That means that you can afford to pay for the debt that you have taken on, plus leave enough breathing room for your day-to-day operations and to reinvest back in your operations. Anything below 1.2 becomes a little bit of a red flag. So if you don't know where that is, calculate that now. And if you're looking at projecting forward, that should be your guide stone. That's where you begin, because with the debt service coverage ratio of 1.2. Project what your net operating income will be. You already know what your debt service is going to be. You know 2 of the 3 numbers. We'll seek for the last one. And that should give you some guidance as well as you look forward. How are we feeling? It's a lot, right? We're good? Okay, awesome. It is a lot. You'll get the presentation. Yeah, here's my contact information. I have cards. I will be at the award ceremony tonight because it is my favorite award ceremony of any state I have ever been to. I mean, the Rochester corner is always really loud. I love it. But I love the energy. And I'll be around through the rest of the day. So if you have any questions, want the presentation, this is recorded, but I'm happy to send that off to you in case it takes a while for you to get it. And the last slide is just all of my background that I have included. So because I am the Brewers Association treasurer, I have to encourage you all to go to Indianapolis. If you're not going to be there, we will have a members meeting. All of us that are on the executive committee are there to answer your questions, and Bart's going to give you an update on what's happening within the industry as well. But I hope to see you all in Indianapolis. Thank you again for having me back for my 6th New York conference. It is always such a pleasure to be here, and I'm here for you. I'm here for us. Numbers rule. Go New York. Cheers.